Hello, and welcome to another in my series of mortgage videos. Now that you've set your budget and worked out a comfortable payment for yourself every month, it's time to look at the mortgage term. You may have been told, usually by your parents, to have a 25-year mortgage. That's because, a long time ago, that was the longest that lenders would allow. Things have changed now, and it's a good idea to set the term according to your circumstances. Most lenders will lend to you for a maximum of 35 years, although one or two will allow up to 40. However, unless you are due to get a large pension, they do not want to lend past your retirement age. The only issue is that there's currently no age that you actually have to retire. You will start to get a pension at age 67 or 68, but that doesn't mean that you actually have to retire. To counteract that, most lenders won't lend past your age 70, or when you intend to retire. Whilst it's tempting to say that you're going to retire age 70 in order to borrow as much as possible, it's also sensible to consider this carefully. Whilst you may change lenders many times over your working life, every mortgage that you have involves a commitment for the whole term. It's important to be realistic with yourself. Can you really see yourself wanting to do your job all the way to your 70th birthday? Once I've been able to give you a good idea of the amount that a lender will lend to you, and you've confirmed that you should be able to find a property that you might be interested in, it's a good idea to see what the payments would be. As we looked at previously, there's different types of mortgage rates, but we can get a good idea of what the payments will actually be. Once we can see this, we can return to our monthly mortgage budget and see how it compares. If the figure is considerably less, then you've got a decision to make. You could think that this is a great thing and your life is going to be a whole lot easier and you're going to have a lot more expensible money every month. There's nothing wrong with this way of thinking, and a lot of my clients would agree with you. But this would inevitably leave you paying more in interest and compound interest over the years, and we're potentially talking about thousands. It also means that you could still be paying off the mortgage in years to come when those around you have paid theirs off. The other option would be to reduce the term. This would change the monthly payment to fit exactly what you're looking to pay. Not only will it potentially save you thousands of pounds, but it will also mean that you could pay the mortgage off sooner. Your future selves would thank you for it. Of course, sometimes it's not possible to reduce the term due to lender restrictions on things like affordability. In that case, review your monthly budget, and if it still works for you, then it might be possible to make an overpayment every month. Quite a few lenders will allow a certain amount of overpayment every year with no early repayment charge. And if that allowance fits your budget, then you can make overpayments to achieve the same goal. It's a great idea, but it's also important to check your documentation before we make an application with the lender to make sure that they can do this. If the monthly mortgage cost is higher than your monthly mortgage budget, and the term is as long as is it possible to be, go back to your monthly mortgage budget and see how fair you've been to yourself. And if the answers still come back the same, then you really need to ask yourself, is this the right mortgage for you? There's no right or wrong answer here. What's important is that you have a mortgage that fits you and the way you live, rather than just living for your mortgage. Thanks very much for watching, and I hope you found it useful. Please feel free to make any comments below, and if you'd like to see more, please subscribe. And if I can be of any help in any way possible, please visit my website and contact me, and I'll be delighted to help.